Picture this. It's January 1st, 2026. You're starting with nothing. No stocks, no bonds, no portfolio screenshots to brag about. Maybe a paycheck that keeps the lights on, maybe some lingering debt, and that's it. Meanwhile, the headlines are loud. Interest rates, AI replacing jobs, housing prices that look more like serial numbers than homes. This is where most people mentally quit. They decide the system is broken, the odds are stacked, and there's no point playing. So they don't. But if I had to start from absolute zero today, knowing what I know about compounding, market cycles, and how people actually behave under pressure, I wouldn't panic. I'd do the opposite. I'd argue that 2026 is one of the cleanest starting points we've had in years, if you're disciplined enough to ignore the noise. What I'm about to walk you through is not a shortcut. It's not about flipping money or chasing trends. It's the mathematical path to your first $100,000 and eventually your first million, built specifically for the economic environment we're entering. And it starts with a number most people avoid because it makes them uncomfortable. Before we go any further, let's make a deal. I'm breaking this into 4 phases: the foundation, the engine, the portfolio, and the tax shield. This is a full roadmap. There's no course pitch at the end, no secret upsell. The only thing I'm asking for is your attention and your honesty with yourself. If you want to treat this channel like a peer review session for your finances, subscribe. My goal here is simple: deliver the highest return on investment you can get for your time on YouTube. Now, if I'm starting from zero, the first decision isn't which stock to buy. That comes later. First, I have to deal with the invisible weight dragging me backward. I call it negative compounding, and it usually hides behind a monthly payment. The debt illusion. There's a dangerous myth floating around that you can out-invest bad habits. I see it constantly. People asking whether they should buy crypto or a tech ETF while sitting on high-interest credit card debt. The logic sounds harmless. If the market averages 10% and my debt is 20%, I'll catch up eventually. That logic is wrong. That's like pouring water into a bucket with a hole in the bottom and calling it progress. If I'm starting fresh, I have to accept something uncomfortable. My net worth isn't zero, it's negative. And until that's fixed, the stock market is off limits. That may sound extreme, but the math is non-negotiable. Paying off a 20% credit card balance is a guaranteed 20% return. There is no legitimate investment that offers that without serious downside risk. Let's strip the emotion out and look at numbers, because feelings lie, math doesn't. Say you're carrying $5,000 in consumer debt at 24% interest. Make only minimum payments and you'll pay back close to double that over the next decade. Now imagine taking the same monthly payment and investing it instead. Yes, you might see gains, but the interest drag is quietly erasing your future in the background. In 2026, borrowing isn't cheap. Rates may stabilize, but the era of free money is over. Every dollar you send to interest is a dollar that never gets the chance to compound for you. So my approach at zero is unapologetically aggressive, but not in the way most people think. At this stage, I'm not an investor. I'm a debt destroyer. The math is clear. You don't build a house on unstable ground. You clear the site first. Here's the part most people miss. Debt sticks around because it feels manageable. It's just another line item, like Netflix or your phone bill. Over time, you stop noticing it. But psychologically, debt does real damage. When you owe money, you think smaller. You hesitate to take career risks. You don't negotiate aggressively because losing your job isn't an option. You stay in cities you've outgrown. You pass on better opportunities because moving feels too dangerous. The real cost of high-interest debt isn't just 24% APR. It's the life you don't pursue because you're financially handcuffed. So eliminating debt isn't just a money move, it's a mental unlock. It's what allows you to play offense later instead of spending your life on defense. Phase 1 protocol. This part is intentionally boring and brutally effective.
I list every liability, ordered from highest interest rate to lowest. Balance size doesn't matter, only the rate does. This is the avalanche method. Every extra dollar goes toward the highest interest debt. Everything else gets the minimum. No emotional decisions, no spreading money around to feel progress. I sell things I don't use. I downgrade subscriptions. I treat this like an emergency because mathematically it is. And when that high-interest debt is finally gone, I don't celebrate by upgrading my lifestyle. I don't buy a watch. I don't reward myself with a new monthly payment. I take that freed-up cash flow and prepare for the next step. Because before a single dollar touches the stock market, there's a trap that wipes out most new investors: the emergency trap. This is where people blow it. They think, debt's gone, time to buy the S&P 500. If you do that immediately, the odds are stacked against you. Statistically, most people who skip the next step fail within about 18 months. Why? Because life doesn't pause for your investment plan. Cars break down, teeth crack, medical bills show up, and when those emergencies hit during a market downturn, you're forced to sell stocks at the worst possible time. That's not bad luck, that's bad structure. Selling during a drawdown locks in losses and permanently damages compounding. Once that happens, you're behind for years. The solution is simple, but unpopular. You need a buffer. The cash problem that isn't a problem. You've heard the phrase, cash is trash. Social media will tell you inflation is stealing from you, so you should always be fully invested. That advice ignores context. In the early stages, cash isn't an investment, it's insurance. If I'm starting in 2026, I'm building a cash fortress before I buy a single share of stock. This is my sleep at night fund. It's liquid, boring, and intentionally unexciting. People hate this phase because it feels slow. The savings balance creeps up, there's no adrenaline, no big percentage gains. But what feels like stagnation is actually stability. Let's run a simple comparison. Two investors, same income, same skills. Investor A puts everything into the market. Investor B keeps $10,000 in a high-yield savings account, earning 4%. The market drops 20%, which happens regularly. Then both investors lose their jobs. Investor A is forced to sell stocks at the bottom just to cover basic expenses, permanently locking in that loss. Investor B uses the cash buffer, leaves their investments untouched, and waits for the recovery. Same market, same downturn, completely different outcomes. When the recovery finally comes, Investor A is damaged, Investor B is intact. That's the difference. The math always favors the person who never has to sell at the wrong time. But there's a second layer most people ignore: psychology. When you've got 3 to 6 months of living expenses sitting in cash, your posture changes. You negotiate harder. You make decisions without desperation in your voice. You stop clinging to bad situations because you finally have options. This is why most investing mistakes aren't analytical, they're emotional.
People panic sell when screens turn red. They chase rallies when everything's green because of FOMO. A cash buffer inserts a gap between impulse and action. It gives your nervous system time to calm down. With a buffer, a market crash looks like a clearance sale. Without one, it looks like an existential threat. If you're trading from fear, the market will punish you relentlessly. The buffer protocol. This part is not optional. I calculate my bare minimum survival number: rent, food, utilities, and basic transportation. No lifestyle padding, just survival. Then I multiply that number by 3. That's the target. This money lives in a high-yield savings account or a money market fund. In 2026, access to these tools is frictionless. I automate transfers from every paycheck until the bucket is full. Once it's full, I pretend it doesn't exist. It's not for vacations, it's not for gadgets, it's not for lifestyle upgrades. It's insurance. Only after that bucket is full do I even glance at the stock market. And this is where I'm going to push back against conventional wisdom: the diversification mistake. You've cleared your debt, you've built your buffer, now you've got an extra $500 a month to invest.
The usual advice is to spread it around, some crypto, some international stocks, maybe a little gold just in case. That advice is backwards when your portfolio is small. Early over-diversification doesn't protect you. It locks you into average results before you've built any meaningful base. Here's the rule most people learn too late. Concentration builds wealth. Diversification preserves it. The stock-picking fantasy. The urge to pick individual stocks is powerful. Everyone wants to catch the next Nvidia or Amazon before the chart goes vertical. In 2026, that temptation will be amplified by AI tools, promising data-driven alpha and predictive models. Here's the uncomfortable truth. Consistently picking winners is brutally hard, even for professionals. The idea that you need to be smart enough to find the best stocks is wrong. You just need to avoid picking the worst ones. Look at the SPIVA scorecards, which track how active fund managers perform against the S&P 500. Over 15-year periods, more than 90% of them underperform the index. These are teams with full-time analysts, proprietary data, and institutional resources. If they can't beat the market consistently, the odds of doing it in your spare time are effectively zero. When I buy a total market index fund, I'm buying the entire haystack. That guarantees the market return, which historically averages around 10% before inflation. When I try to pick stocks, the range of outcomes explodes. Maybe I hit a 30% winner. Maybe I wipe out 50%. Early in the wealth-building phase, reliability beats lottery tickets. The math is clear. Being average in the stock market is more than enough to make you wealthy. The issue with index investing isn't that it fails, it works exceptionally well. The problem is that it's painfully boring. There's no adrenaline, no alerts lighting up your phone, no earnings call drama or charts exploding upward with rocket emojis. You buy something like a total market index fund, and then nothing happens for months, sometimes years. And psychologically, that messes with people. We're wired to associate effort with reward. We want to feel like we're doing something to earn our progress. This is exactly why day trading, options, and hyperactive strategies are so seductive. People are willing to pay fees, accept bad odds, and absorb stress just to feel involved. If I'm building a strategy in 2026, I have to be honest about that flaw in human psychology, including my own. Good investing should feel dull, uneventful, almost forgettable. If it's exciting, there's a high probability you're not investing, you're gambling. So instead of fighting that instinct, I contain it. The core satellite structure. Here's the framework that keeps most people sane and solvent. 90% of my investable money goes into low-cost, broad market index funds. Think total U.S. market exposure, plus some international diversification.
This is the core. It's automated. Contributions happen on schedule. I don't check it daily. I don't tweak it. I don't react to headlines. This portion of the plan exists to compound quietly in the background while I live my life. Then, and only then, I take the remaining 10%. Not 20, not whatever feels right, 10%. This is the satellite. This is where I'm allowed to be human. If I want exposure to a specific tech stock, a thematic ETF, or even crypto, it lives here. If it goes to zero, my financial future is intact. If it takes off, great. It adds upside without threatening the foundation. This structure scratches the urge for action without letting that urge sabotage the entire plan. Most people fail because they let speculation leak into their core capital. Once that happens, discipline collapses. But even with the perfect investment strategy, there's still a massive leak most people ignore. The tax drag nobody talks about. You can choose the right funds, you can automate perfectly, you can stay invested for decades, and still lose a third of your wealth. How? Taxes. Returns get all the attention, net results don't.
Most people just open an app, link a bank account, and start buying assets in a standard brokerage account. It feels productive, it feels flexible, and it's quietly expensive. Every profitable sale triggers capital gains tax, every dividend gets taxed, every rebalance creates friction. Over 20 or 30 years, that tax drag compounds into a massive loss of wealth. So we need to talk about location, not where you live, but where your money lives. Understanding account priority. Taxable brokerage accounts aren't bad. They're flexible. You can access your money whenever you want. But flexibility comes with a cost: zero tax protection. If I'm starting in 2026, I'm treating the tax code like a rule book. The government explicitly rewards long-term saving and retirement investing. Ignoring those incentives is voluntary wealth destruction. The order matters. Before I put serious money into a taxable account, I fill the tax-advantaged buckets. Here's why that matters in real numbers. Imagine you invest $10,000. Over 30 years, it grows to $100,000. In a taxable account, that $90,000 gain doesn't belong entirely to you. Depending on future tax policy, you might owe 15% or 20% in capital gains. That's $15,000 to $18,000 gone. Not because you picked bad investments, not because the market underperformed, but because the money lived in the wrong account. Now compare that to a Roth IRA. Same investment, same growth, same timeline. Follow the rules, and when you withdraw, the entire $100,000 is yours, tax-free. That difference isn't skill, it isn't intelligence, it's structure. And if you have access to a 401k with an employer match, the math becomes even more obvious. An employer match is an instant guaranteed return, often 50 or 100% on your contribution. There is no legal investment strategy in the public markets that beats that. Ignoring it isn't conservative, it's irrational. This is why wealth building isn't about being clever. It's about removing leaks, stacking small advantages, and letting time do the heavy lifting. The biggest pushback I hear at this stage isn't about returns, it's about access. People say, "Michael, I don't want to lock my money away until I'm 59 and a half. What if I want to retire early? What if I need flexibility?" That fear pushes people to skip tax-advantaged accounts entirely in favor of liquidity. On the surface, that sounds reasonable. In reality, it's usually self-sabotage. Here's the psychological twist most people miss. Locking money away protects you from yourself. It creates friction, and friction is a feature, not a bug. If your retirement money is easily accessible, it becomes tempting. It slowly turns into a backup plan for lifestyle upgrades, cars, weddings, once-in-a-lifetime trips that somehow happen every few years. The early withdrawal penalty isn't there to punish you, it's there to stop you from quietly dismantling your future. That penalty acts as a behavioral guardrail. And the fear is often overstated anyway. With accounts like a Roth IRA, your contributions, not the gains, can be withdrawn without penalty if absolutely necessary. There are structured ways to access retirement funds early under specific rules. Most of the resistance isn't about flexibility, it's about discomfort with committing to a long-term plan. The waterfall system. This is where precision matters. The order is not optional. Think of this as a waterfall. Money flows down in a specific sequence. Step 1. Contribute to your 401k up to the employer match. This is non-negotiable. That match is instant, guaranteed return. No market strategy can touch it. Step 2. Max out a Roth IRA. In 2026, contribution limits will likely be higher, so check current caps. This bucket grows tax-free and gives you flexibility later. Step 3. If you have access to a high-deductible health plan, fully fund an HSA. This is the most powerful account available, triple tax-advantaged. Contributions are tax-deductible, growth is tax-free, and qualified withdrawals are tax-free. Step 4. Go back and finish filling your 401k. Only after every one of these buckets is full do I put a single dollar into a taxable brokerage account. This sequence creates a tax shield that dramatically accelerates compounding over decades. Most people don't fail because they pick bad investments. They fail because they put good investments in bad containers. But even if you execute all of this perfectly, there's one constraint you cannot escape: the income ceiling. We've covered spending discipline, we've covered investing mechanics, we've covered taxes, but there's a limit to how much you can optimize on the expense side. There's a hard floor on spending. You can only cut so much before you start cutting into quality of life. Income, on the other hand, has no theoretical ceiling. If you want to compress timelines meaningfully, spreadsheets alone won't do it. This is where the uncomfortable work begins. The frugality trap. We've all heard the advice: stop buying lattes and you'll be rich. This is the latte effect myth. Yes, reckless spending matters, but you cannot budget your way to wealth on a low income in 2026. Inflation keeps moving the goalposts. If all your energy goes into clipping coupons and squeezing pennies, you're stuck in defense mode. Defense keeps you alive. Offense is how you win. At some point, the question has to change from "how do I save $5" to "how do I earn $5,000?" Linear income versus leverage. Side hustles get a lot of attention, and some of them are useful. Driving for a rideshare app might net $20 an hour after expenses, but it's linear income. When you stop working, the money stops too. Compare that to upgrading your primary income through a high-leverage skill. Learning data analysis, specialized sales, technical coding, or another in-demand skill can permanently raise your salary by $20,000 or $30,000 a year, and that increase compounds. Higher salary means larger 401k contributions, higher employer matches, higher Social Security credits, bigger raises built on a larger base. A 10% raise on a $50,000 salary beats years of weekend gigs over a lifetime. This is why income growth is the ultimate accelerator. You don't escape the system by pinching harder. You escape it by expanding your capacity. The math is blunt on this point. Your first and best investment is your primary income engine. This is where psychology quietly works against you. Learning new skills is uncomfortable. It's slow. It makes you feel incompetent again. It's far easier to choose quick, low-friction income, driving, delivery, small gigs, because you already know how to do them. But low friction always comes with low barriers to entry, and low barriers mean low pay. If I'm starting from zero, I don't get to avoid discomfort. I have to lean into it. That means being a beginner again. It means asking dumb questions. It means looking unpolished while I build something valuable. The comfort zone feels safe, but it's where financial goals slowly suffocate. The skill audit. This is the final protocol, and it's the one most people skip. I look at my current job or field and ask one honest question: what single skill, if I mastered it, would make me hard to ignore? Not 10 skills, one. Maybe it's public speaking. Maybe it's mastering a specific software. Maybe it's technical analysis, data work, sales, or project management. The exact skill doesn't matter as much as the leverage it creates. Then I make a trade. 1 hour a day, the time I would have spent scrolling social media, I redirect into learning that skill. No excuses, no waiting for motivation. I use free or low-cost resources, tutorials, documentation, practice projects. 6 months later, I apply pressure. I ask for a raise. I apply for a higher tier role if needed. This is how income jumps happen.
And income is the multiplier that makes every other strategy work faster. A 20% savings rate on $100,000 is vastly more powerful than the same discipline on $50,000. The percentage doesn't change, but the outcome does. The 2026 Playbook. So if I woke up tomorrow in 2026 with nothing, this is the exact sequence I'd follow. First, eliminate high-interest debt using the avalanche method.
That's a guaranteed return no market can beat. Second, build a 3-month cash fortress, not to earn returns, but to survive volatility without selling assets. Third, open and fund tax-advantaged accounts, 401k and Roth IRA, using the waterfall method to minimize tax drag. Fourth, invest primarily in boring, low-cost index funds. Keep speculation confined to a tiny, controlled slice of the portfolio. Fifth, aggressively upgrade my primary skill set to raise my income and increase the size of my financial engine. None of this is flashy. There's no hack, no secret timing trick, no overnight transformation. It's not a get-rich-quick plan. It's a get-wealthy-for-sure system. I've run these numbers every way you can run them. Different markets, different assumptions, different time frames. They always lead back to the same fundamentals. That said, personal finance is personal. Maybe you approach debt differently. Maybe you prefer a different asset mix. If you do, I want to hear it. Drop your strategy in the comments. I read them, not for validation, but to catch blind spots. And if this breakdown was useful, consider subscribing. It keeps the lights on, the spreadsheets open, and the analysis honest. Thanks for watching. I'll see you in the next one.